Did you know that more than 60% of Americans wouldn't survive even 1 month if their banks suddenly limited access to their own money? Now here's the disturbing part. This exact risk just quietly increased overnight. While most people were sleeping, Florida approved a new banking rule, and hardly anyone is talking about it. No alerts, no loud warnings, just a silent change that could affect how, when, and even if you can access your own funds. Ask yourself this. What if the rules protecting your savings yesterday are not the same today? History shows that sudden banking changes never happen without a reason, and they often come right before people feel the real impact. Experts who study financial behavior warn that it's not the collapse that hurts first. It's confusion, delays, and false assumptions. So before you swipe your card, transfer money, or assume everything is normal, stay with me. One overlooked detail could decide whether you're prepared or exposed. Number 1. The rule nobody explained. The most alarming part of this new banking rule isn't what it says, it's how quietly it was approved. Overnight changes in financial rules are rare, and when they do happen, they usually signal pressure behind the scenes. Banks operate on trust and predictability, so when lawmakers move fast and stay silent, experts in financial behavior see it as a warning sign, not a coincidence. Research into past banking disruptions shows that sudden rule changes often come before restrictions, not after them. By the time the public fully understands what changed, the impact has already started. What makes this rule even more concerning is the lack of clear communication to everyday customers. Most people assume their money is always available because it has been that way for years, but studies in consumer finance show that people rarely read updated banking terms, especially when changes are buried in complex language. This creates a dangerous gap between what people think their bank allows and what the new rules actually permit. That gap is where panic, delays, and unexpected limits usually appear. And history proves that confusion hurts customers far more than bad news delivered early. The real issue here is not fear, it's false comfort. Behavioral research shows that when people believe nothing has changed, they delay taking simple protective steps. They don't ask questions. They don't review account terms. They don't diversify access to their funds. And when restrictions finally appear, it feels sudden and unfair, even though the warning signs were already there. This rule doesn't mean your money disappears overnight, but it does change the balance of control. Understanding that shift early is what separates people who stay calm from those who get caught off guard. Number 2. Why it was passed so fast. When financial rules move this quickly, there is usually a deeper reason. Major banking regulations normally take months of discussion, revisions, and public commentary. But this one moved through quietly and rapidly. That alone raises questions. Research into past financial policy changes shows that speed often signals preventive action, meaning lawmakers may be responding to stress signals most people cannot see yet. Banks monitor liquidity, withdrawal patterns, and economic pressure constantly. If something looks unstable behind the scenes, regulators sometimes act first and explain later. Another reason rules move fast is to prevent panic. Behavioral finance studies show that once the public hears the word restriction, withdrawals can spike dramatically within days. That reaction alone can create the very instability officials are trying to avoid. So instead of announcing dramatic warnings, changes are often framed as technical adjustments. But technical adjustments can still have real effects. The problem is not always the rule itself. It's the timing and the lack of clear explanation that creates uncertainty. And uncertainty spreads faster than facts. The important thing to understand is this. Sudden financial decisions are rarely random. They are usually tied to broader economic signals, rising debt levels, market volatility, or shifts in banking reserves. Most people never see those indicators. They only feel the effects later. That's why staying informed matters. If a rule was passed quickly, ask yourself why urgency was necessary. Because in finance, speed usually means someone saw a risk forming. The question is whether everyday customers will understand that risk in time, or only after it begins affecting access to their own money. Number 3. Who gets affected first? When banking rules change, they do not affect everyone at the same time. Research in financial risk behavior shows that the impact always hits specific groups first, while others feel nothing, at least initially. Large institutions and wealthy clients usually receive early guidance, private explanations, and customized protections. Everyday customers, on the other hand, often find out only when something feels different. A transfer takes longer, a withdrawal gets flagged, a routine action suddenly requires extra approval. These small frictions are usually the first sign that a rule is already working behind the scenes. People with fixed incomes, small businesses, and large savings kept in one account tend to feel the pressure earlier than most. Studies on banking access during regulatory shifts show that accounts with higher balances or unusual transaction patterns are monitored more closely under new rules. Seniors and small business owners are especially vulnerable because they rely on predictable access to funds for daily expenses, payroll, or medical needs. When access slows even slightly, the stress multiplies. Not because the money is gone, but because control feels uncertain. The real danger is assuming you are not in the affected group. Behavioral research shows that most people believe financial changes apply to someone else until they experience it personally. That belief delays action. It stops people from asking questions or preparing alternatives, and by the time they realize the rule applies to them, options are limited. Banking rules don't usually announce themselves with alarms. They show up quietly, through inconvenience and delay. Recognizing who typically gets affected first gives you a chance to respond early, before confusion turns into panic. Number 4. The hidden access shift. One of the most overlooked effects of new banking rules is not the safety of your money, it's the speed and control of access. Financial studies show that during regulatory adjustments, banks often tighten internal review processes before customers even notice. This can mean longer verification checks, added transaction monitoring, or temporary holds that feel random. The money is technically still there, but the freedom to move it instantly may not be as simple as before. For most people, access feels guaranteed until it slows down. Research on consumer banking behavior reveals that people value immediate availability more than they realize. We swipe cards, schedule transfers, and pay bills assuming everything will clear smoothly. But when new compliance rules are introduced, banks frequently adjust withdrawal thresholds or flag larger transactions for review. These measures are often described as protective, yet they can create delays during urgent situations. Imagine needing quick access for a medical bill, property closing, or business expense, and facing unexpected waiting periods. That's where frustration begins, not because funds disappeared, but because timing changed. The shift here is subtle but important. Control moves slightly from the customer to the institution. Behavioral finance experts warn that when people assume full access without verifying updated policies, they expose themselves to unnecessary stress. The smartest move is not panic, it's preparation. Confirm your withdrawal limits, understand processing timelines, ask direct questions about holds or reviews. Because in modern banking, risk rarely looks like loss at first. It looks like delay, and delay in the wrong moment can feel just as disruptive. Number 5. The communication gap. One of the most dangerous parts of any new banking rule is not the rule itself, it's the lack of clear communication. Financial institutions are legally required to notify customers of changes, but research shows that most updates are delivered in ways people rarely read. Long emails filled with legal language, policy updates buried inside online banking dashboards, technical notices written in complex wording that feels harmless. Studies in consumer behavior reveal that over 70% of customers do not fully review updated banking terms, especially when the changes appear routine. That silence creates a gap between what customers believe and what is actually in effect. This communication gap can create a false sense of security. When there is no bold headline, no urgent alert, and no dramatic announcement, people assume nothing meaningful has changed. But financial history shows that many impactful adjustments were introduced quietly, framed as operational updates or compliance improvements. The problem is not that banks are hiding information, it's that they present it in a way that feels unimportant. And when customers don't understand the change, they continue banking as usual, unaware that certain conditions may now apply differently than before. Behavioral experts call this the normalcy bias, the tendency to assume tomorrow will function exactly like yesterday. That belief keeps people calm, but it also keeps them unprepared. The safest approach is not fear, but awareness. Review notifications. Log into your account settings. Ask your bank directly if any new rule affects withdrawal timing or account access, because in banking, what you don't notice is often what matters most. And the real risk is not always the rule, it's the misunderstanding surrounding it. Number 6. Simple steps that reduce your risk. The good news is that protecting yourself doesn't require expert knowledge or dramatic action. Research in personal finance consistently shows that small, early steps reduce stress and prevent rushed decisions later. Start by understanding how your money is currently accessed. Check daily withdrawal limits, transfer timelines, and any conditions tied to larger transactions. Many people assume these details never change, but new rules often adjust them quietly. Knowing the exact boundaries of your account gives you control, and control reduces fear. Another proven strategy is avoiding single-point dependency. Studies on financial resilience show that people who rely on one account, one bank, or one access method feel the most pressure during policy changes. This doesn't mean moving all your money. It means creating options. Having funds accessible through more than one institution or keeping a portion in a different form reduces risk if delays occur. Think of it like a backup plan. You may never need it, but if access slows unexpectedly, you're not trapped waiting. Finally, communication matters more than people think. Financial behavior research shows that customers who ask direct questions early experience fewer surprises later. Call your bank. Ask how the new rule affects holds, transfers, or large withdrawals. Don't wait until there's an emergency. This isn't about distrust, it's about clarity. Banking rules don't usually cause problems on their own. Problems arise when people assume instead of confirming. Staying informed, diversified, and proactive turns uncertainty into preparedness, and preparedness is the strongest form of protection. Number 7. What happens if people ignore this? History shows that financial rules rarely create chaos immediately. They create slow pressure first. Research on past banking adjustments reveals a clear pattern. The majority of customers ignore early warnings because nothing feels different at first. Transactions still go through. Cards still swipe. Apps still show the same balance. That smooth surface creates confidence. But underneath, internal policies may already be shifting. And when people don't review changes early, they are the ones most surprised when limits, reviews, or delays suddenly apply to them. Behavioral economists call this the wait-and-see trap. Most individuals delay action until they personally experience inconvenience. The problem is that financial systems move faster than personal reactions. If a rule affects transfer timing or withdrawal thresholds, waiting until the moment you urgently need funds is the worst time to discover it. Studies show that people who act only after disruption tend to make emotional decisions. Rushed withdrawals, unnecessary account closures, or panic-driven moves that create more instability for themselves. Ignoring change doesn't make it disappear. It simply reduces your response window. The smartest approach is calm awareness, not panic, not fear, just preparation. Financial systems reward those who move early and thoughtfully. They challenge those who assume stability will always continue uninterrupted. If this rule turns out to have minimal impact, you lose nothing by reviewing your position. But if it quietly reshapes access conditions, you gain something powerful. Time to adapt before pressure builds. And in finance, timing often determines who stays secure and who scrambles to catch up. Number 8. The bigger picture most people miss. Banking rules don't exist in isolation. They are usually part of a larger financial pattern that unfolds slowly, often unnoticed by the public. Research into economic cycles shows that regulatory shifts tend to cluster around periods of uncertainty, rising debt, market volatility, or tightening liquidity. Most people only focus on the single rule in front of them, but professionals look at what comes before and after. A quiet rule change today can signal additional adjustments tomorrow, each one small on its own, but meaningful when combined. This is where many people misjudge risk. They ask, is this rule dangerous by itself? When the better question is, what direction are things moving? Studies in systems finance show that gradual restrictions normalize new behavior. What once felt unusual becomes standard. Processing delays become expected. Extra verification feels routine. Over time, people adapt without realizing how much has changed. That doesn't mean the system is failing. It means control is slowly shifting. And those who notice early can adapt smoothly, while others feel blindsided later. Understanding the bigger picture changes how you respond. Instead of reacting emotionally to headlines, you start watching patterns. You stay flexible. You keep options open. Financial stability isn't about predicting disasters. It's about recognizing signals. This rule may never directly disrupt your life, but it teaches an important lesson. Rules can change quietly, and preparedness must be ongoing. The people who stay financially calm during uncertain times are not the ones with the most money. They are the ones paying attention. And attention, more than anything else, is what turns uncertainty into confidence. Number 9. Why calm beats panic every time. When people hear words like banking rule and risk, the natural reaction is fear. But research in behavioral finance consistently shows that panic causes more financial damage than the rule itself. Sudden emotional decisions, rushing to withdraw money, moving funds without a plan, or believing worst-case rumors, often create unnecessary losses and stress. In past regulatory shifts, the people who struggled most were not those affected by the rules, but those who overreacted without understanding them. Calm decision-making is a measurable advantage. Studies show that individuals who pause, gather information, and act methodically preserve more access and flexibility than those who react emotionally. Banking systems are designed to handle informed customers, not sudden surges driven by fear. When panic spreads, systems tighten further, reviews increase, and delays become more common. Ironically, fear creates the very inconvenience people are trying to escape. Staying calm keeps you ahead of that cycle. This doesn't mean ignoring change, it means responding intelligently. Review facts instead of headlines. Ask questions instead of assuming outcomes. Make small adjustments instead of dramatic moves. Financial rules test patience more than anything else. Those who remain steady maintain control, while those who rush often give it up. In uncertain moments, clarity is power, and clarity only comes when emotion steps aside and preparation takes its place. Number 10. Awareness is your real protection. The biggest mistake people make with financial changes is believing protection comes from institutions alone. Research in personal finance shows that awareness consistently outperforms blind trust. Banks follow rules, regulators adjust systems, but individuals who understand what's changing, even at a basic level, experience fewer surprises and less stress. Awareness doesn't mean predicting crises. It means knowing where you stand, how your money moves, and what assumptions you're making without realizing it. Financial stability is rarely lost in one dramatic moment. Studies show it usually erodes through small, unnoticed shifts. A delay here, a new requirement there, a policy update that goes unread. People don't react because nothing feels urgent, until suddenly it is. Those who stay informed adapt gradually and comfortably. Those who don't are forced to react under pressure. That difference isn't luck, it's preparation meeting timing. The purpose of understanding this rule isn't fear, it's confidence. When you know the system can change, you stop assuming and start verifying. You check access instead of trusting habit. You plan instead of hoping. And that mindset protects you far more than any single rule ever could. Because in the end, the most secure people aren't the ones with perfect systems. They're the ones paying attention. If this video made you pause and think differently about your money, tell us in the comments. What's the one thing you're checking in your bank account today? Your experience could help someone else avoid a mistake. Don't stop here. Watch our previous video where we break down another hidden financial rule most people miss. We put hours of research and effort into bringing you clear, honest information, and your support truly matters. Subscribe to the channel. It's just one click, but it helps us keep exposing what others don't explain.